The population remains the fundamental when it comes to the change of property prices and the growth. And yes, credit creation is an important part of the puzzle, but population drives the major growth.
We've got a skilled workforce unemployment rate of around 1%, or will have soon, which means that there's a huge shortage of skilled workers in Australia.
Everyone talks about the National Housing Accord target of 1.2 million. I was like, well, even if we meet the target, we are still not there because the population is growing even faster than the target, right?
We've had a number of rate cuts over the last year. We probably won't get any more until early in 2026, but I believe that interest rates will start to come down again. They're still too high.
If you really look at it, it's like government putting fuel to the fire saying, oh, we want these prices to rise because A, it's contributing towards the GDP and the growth side of things, and B, provides a strong solution for first-home buyers. But it's only a window of opportunity, right? And there would be people who would make money, right? I call them opportunistic investors. They will make money, they'll take an exit and, they move into the markets, make the money, get out. But majority of the mom and dad investors who've been bought into this dream of buy and hold it forever, I think those are the people who would suffer the most. Hello and welcome to another episode of Help Me Buy Property Podcast. This is one of the last podcasts. I wanted to end this with a big bang. So today's discussion, we are going to talk about the major shifts in the Australian property market. We are going to talk about the surprises. We are going to talk about the areas which people think are great to invest, but should not be investing, is areas or macroeconomic indicators that the risk investors should look out for, the suburbs and regions to avoid, the strategy mistakes that people are basically doing all the time. And in order to have this conversation, I'll have their property guru, Mr. John Lindeman. How are you today? Thank you for joining in.
Hi, Moss. I'm great, and it's wonderful to be here. Last one for the year, eh? So it's gone very quickly, hasn't it?
It's flown, right? And since your last appearances, there has been a lot of things that has happened within the Australian property market space. So let's start there. What are the major shifts in the Australian property market that has surprised you the most, over the span of the full year, and what are you seeing in the future?
Okay, so to do that, I'll just share my screen.
Yes. For viewers and listeners, I know I get so many comments, so many emails about John's view of the world, and how truly appreciative they are of the insights that we bring out in this podcast at least once a month. So it's quite interesting and amazing as to the way that we discuss data. So over to you, John.
Thank you very much, Ross. Yeah, we take it very, very seriously. I've been doing it a long time and, place great reliance, I think, on two things. One is what the data's telling me, but also going out and having a look. We've been to Victoria, New South Wales, southern parts of New South Wales, Tasmania. And before the year's end, I'm going to the Sunshine Coast to have a look up there. So it's all about, looking on the ground, what's really happening. So we're going to cover the major shifts, the landscape and areas to avoid. So I'll move on to the major shifts in the last year. And to do that, I'm looking at the PropTrack or CoreLogic data. So this is official housing data. And when you look at this, it's quite interesting because this is what's happened over the last year to the end of October. And you can see that the best performing capital city was Darwin with over 15% growth, Brisbane second, and then Perth. Now we have a look at the next quarter and you'll notice that Darwin's still on top, but Perth has caught up. So it's had the same growth rate. And I don't think anyone really expected those two things to happen. One is that Darwin would boom, but also now Perth is going at the same growth rate. Brisbane is third.
Yeah.
Now let's have a look at the last month. And what you can see here is that Perth is now the best performing capital city in the whole of Australia. And again, I don't think anyone would have predicted that. They all thought, a lot of experts were saying that Perth's market was overcooked, and it was going to stop growing. Well, it hasn't. It's continuing to grow. Brisbane is now the second best performer, and Darwin has slipped down to third. And I think that is a real, there's a message there that's telling us that maybe we should be looking more carefully at Darwin and seeing what's actually going on there.
Yeah. It's quite interesting as to how numbers are shifting quite dramatically in a short span of time. Like, you're not talking about years, we're talking about months, quarter of over quarter. And yes, a lot of people didn't expect it, and you're including me, and we did a lot of buying in Perth, and all the indications typically were that, Perth is going towards matured state. Perth is, the hotness is there, but it's going to start cooling off. But a lot of government incentives, through the fuel to the fire, and we can talk a bit about that as well
Yeah,
through this.
excellent. So when we look at the median housing price, you can see that Sydney's still on top. Brisbane is still second, but now Perth is third. And only a few months ago, it was the fifth highest. It's jumped up to third highest. It's gone ahead of Adelaide and also Canberra. But
Mm,
as it's growing at a faster rate, and if this trend is to continue, then we can see that possibly Brisbane and Perth could actually be dearer to buy property than Sydney sometime next year.
yeah.
Then we get Canberra fourth, but it's a very, very low growth rate. Adelaide is starting to slow down as well. And Melbourne sixth is actually starting to speed up. Hobart improving its position. And of course, Darwin is still the cheapest, but has had a lot of price growth in the last year. So what about the landscape looking ahead next year? What do we see likely to occur? And to do that, I've used a number of what are the main indicators that we rely on? And the first one is population growth. And this chart here shows you our population growth in Australia from World War I to 2035. So it's not just the past, but predicting based on current trends what will happen. And you can see here that rate of growth is actually increasing over time.
Mm,
We've always had positive population growth. You can see the little bit of a slip that was during COVID.
yeah.
We didn't have any growth at all for 2 years, and now it's all kicking off again.
Yeah.
The interesting thing there, Moss, is that when you look at the change comparisons, the rate of population growth, Australia is got the highest population growth rate of any Western country. There it is on the left. It's followed by New Zealand, Canada, India, UK. So even though India has got a lot more people, the annual growth rate is now lower than Australia.
Mm,
China's a lot lower, France, Germany, and so on. Then over on the right, you've got the red ones where the population is actually falling.
yeah.
And of course, everyone needs a place to live. So if you've got increasing population, more demand for housing.
Yeah.
Decreasing population, of course, a decreasing number of people need property. And not only that, but of course, the people are getting older in those countries. So the type of housing that they require changes, but that's not the case in Australia.
It's a very interesting slide, right? I was in a podcast about 2 weeks ago, and I was talking to someone in the private equity space. And their view of the world was Australian property cannot continue like this, and there's a sharp decline or a sharp drop that they're expecting out of Perth and out of Australia. And one of the reasons that they quoted was, look at China, look at Germany, look at Europe, look at Italy, look at Greece, and the market have collapsed quite significantly. And everyone is talking about China right now with the oversupply side of things. But one of the core and the most important thing that I kept hammering on is the population remains the fundamental when it comes to the change of property prices and the growth. And yes, credit creation is an important part of the puzzle, but population drives the major growth, and the percentage growth in population is what impacts the property prices quite significantly. And I think this is where it summarizes everything that I was talking about in that podcast. That not only Australia's numbers are higher, it's also the percentage population growth is higher as well. So
that's right. One of the highest in the world,
yes,
and certainly in the Western world.
yeah,
The main indicator that we look at as well is skilled labour. Do we have a shortage or surplus of skilled labour? And we've got a massive shortage. This is actually the skilled workforce unemployment rate, and it's a percentage of people that are skilled workers that are unemployed. Now, it's very low, but also it had two spikes. The first one was during the recession we had to have in the early 90s, and the second one was during COVID. But if you ignore those two spikes, you'll notice that the trend is actually going down, and so it's reaching 1%. So that means we've got a skilled workforce unemployment rate of around 1%, or will have soon, which means that there's a huge shortage of skilled workers in Australia. And of course, skilled workers are the ones who build properties. So
Mm.
that means we've got a massive housing shortage. We're not building enough properties for whatever other reasons there may be, political or economic or whatever. The
Yeah.
fact is there are not enough people out there to build the properties. So this is the government's housing accord target was 1.2 million new homes. You can see that it's the yellow line. They've stopped talking about that. We're 3 years into it, and they're not talking about the housing accord.
If they can't, right? Because they're so far back behind that target that they can't meet it, right? So, and
Yeah.
and and the funny thing is that their target is actually lower than the population growth target.
Mm.
So, which is quite interesting, right? Because everyone talks about the National Housing Accord target of 1.2 million. I was like, well, even if we meet the target, we are still not there because the population is growing even faster than the target, right?
That's right. And it's getting worse. You can see there the blue columns, they're the number of completions, and they're dropping, so the rate of housing completions is falling even as the demand is increasing.
Mm.
Then we've got falling interest rates. We had a number of rate cuts over the last year. We probably won't get any more, until early in 2026. But I believe that interest rates will start to come down again. They're still too high. And so that means, of course, that people have got more purchasing power. They already have now, and they'll get even more as interest rates continue to fall next year or in 2026. But the big one is the first home guarantee scheme, and that's really going to have a huge impact on property prices.
Mm.
It was brought forward to the 1st of October, but it was based on the premise that prices would rise. So as long as housing prices rise, then guaranteeing the 15%, if they fall, doesn't really come into the equation because they
Yeah.
won't fall. It doesn't
Yeah.
cost the government a cent. No place limits. All Australian first-home buyers can apply. Thousands have already done so, and mortgage brokers are telling me that they just have, the turnaround time is increasing dramatically because they can't service all the applications that they're receiving.
Yeah.
No income caps. It doesn't matter how much money you earn. If you're a first-home buyer, you can access the scheme and buy a property with just 5% deposit, and the government guarantees the other 15%.
Yeah.
And the price caps, which is really the killer in all this, is that the property price caps have been dramatically increased. This is the chart I've shown here is the first home buyer median price. So this is what a first home buyer could expect to pay in Sydney. It's $1 million, but the cap is 1.5 million. In Victoria, that's in Melbourne and Geelong, the median price for first home is around 600,000, but the cap is 950. If you've got people that have got the 5% deposit and they've got finance, they're going to compete with each other to buy homes in a shortage situation, and that means that prices will keep going up until they reach those new caps. So I don't know when that'll be,
Mm.
but it's a huge increase potential.
Yeah.
And that same thing in Queensland, the cap is 1 million, and it costs around 700,000 to buy a home in Brisbane, cheaper places like Logan and Ipswich. In WA in Perth, the cap has gone up to 850 from 6, and median price for first home buyers around 600,000, and the same in Adelaide, 600,000 has gone up to 900.
Yeah.
So
It's
yeah.
it's quite interesting to see that, when you talk about the first home buyer median price, they're very similar, in pretty much all the states minus New South Wales, right? But the interesting thing that I find is this, right? The government actually wants the prices to rise because, it's counterintuitive. If it doesn't rise, then they're in problem. And so this whole scheme of first home buyers grant, while they make it sound that, oh, we are going to help the first home buyers, it's a small window of opportunity for them because they actually want the prices to rise so that, they can get a clean exit out of this and the 80% LVR can, then kick in and, they walk away free-handed without paying any liabilities against, default rates or home rates, right? So I think it's an amazing scheme. But in hindsight, if you really look at it, it's like government putting fuel to the fire saying, oh, we want these prices to rise because A, it's contributing towards the GDP and the growth side of things. And so we'll continue to deliver higher growth rates as Australians. and B, it provides a strong solution for first-time buyers, but it's only a window of opportunity, right?
It is, and we've just mentioned that they've stopped talking about the National Housing Accord, that target of 1.2 million homes, because it's not, the supply issue is pretty much insolvable. So they've gone on, well, let's fix up the demand by making it easier for people to buy their first home. So increasing the demand, and all that's doing is going to increase the prices rather dramatically. So that's the big one, and the caps are really the big ones, because you can see the potential there over on the right, what first home buyers could be paying for homes in a year or two, and automatically that's going to lead to a massive first home buyer property market boom. So all these indicators are lining up for booms in the most affordable suburbs. So when I look ahead to next year and even beyond, I can see that all these indicators are telling me that we're in for, quite a substantial property market boom.
And John, if I throw a curveball question in there,
don't get yourself taken on a ride by property spookers, so-called property investment advisors, or buyer's agents who are selling house and land packages or off-the-plan properties or apartments. Get yourself a copy of this book called The Millennial's Guide to Property Investing. This book is not just for millennials. The title suggests, but it's actually the most advanced way of investing in property. This book will relate to your clients, your colleagues, and other business owners. There are so many property spookers out there who have come out of the woodwork over the last 3 to 5 years, and there is so much misinformation out there that I had to write a book about all the F-ups that people can actually avoid in order to be super successful in the property investment journey. Some of these are really easy to identify, but they are so costly to fix once these mistakes are made. So it's a short book, it's easy to read, it has a lot of stories, it has a lot of examples, and it is a true guide for people who wants to do it themselves. My name is Moxin Reza. This is my story, and a lot of you will relate to parts of this story if you're not born in the riches and if you're trying to build a property portfolio that can last generations and help you improve your lifestyle along the way. So I give you a chance to come out there and have a read. Be kind, stay safe, keep smiling, keep investing, and please do check out the book.
Is it ever been the case where all of these indicators have lined up perfectly to create a first-time buyer's boom?
They did once. It's only ever happened once, and it was after the end of the Second World War. What happened there was we had a massive increase in population. We had huge skilled labour shortages because all the men had gone off as soldiers to fight in the war. We had a massive housing shortage because they weren't building enough properties. Interest rates were coming down. And instead of the first home grant scheme, what they had was soldier resettlement and low interest rate loans for veterans. So it meant that all these people could suddenly start buying properties. And we had a massive property market boom. So from 1946, for the next 4 years, property prices trebled. It's never happened.
And that was one of the biggest booms in the history, right? If you talk about like 4 decades worth of data, I think that boom hasn't been beaten yet, right? I think it's almost as big as COVID boom, or I think bigger than COVID boom as well, right?
Yeah, it certainly was bigger, and this is now lining up. All these indicators are saying, look, this is exactly the same set of situations that we had then. And it's likely that, housing prices will, I'm not saying they're going to double, but you could see by those caps, they've got the, potential to rise up to 50% in many areas over the next few years.
Yeah, it's amazing. Yeah. Exciting. So areas to avoid, let's talk about that. I think people have been waiting for, where should they not be investing? And I think there will be a lot of surprises for a lot of viewers and listeners, because some of the areas that I'm sure John is going to talk about are areas where people are actively investing, thinking that, Jesus, this is an amazing opportunity. But when you see the fundamentals and risk behind it, you'll realize why John and I are basically talking about some of these areas and, to avoid them for 2026 and beyond.
Definitely. And there's one in particular that I think stands out, and that's Darwin. It's been the best performer over the last year, but that followed 5 or 10 years of virtually no price growth at all. So
Yeah.
it was the most affordable capital city in which to buy property. It still is. But it's got some fundamental problems. If you look at the record of housing price growth, you can see there the massive increase that's occurred, and this is Cotality data, and that happened back here. You can see in 20 to 21, they had a massive rise in housing prices as well. What then immediately followed was a massive crash. It's an extremely volatile, high-risk market in which to buy property, and it's done this before. It goes up and then it goes back down again, and there are a number of reasons for that, which I can now share with you, Melissa, and that is that it's a very different type of market. It's not like other capital cities. There are 3 huge military bases in Darwin, which for the Army, Navy and Air Force, our entire defence capability is centred on Darwin. And that means, if we're not engaged in any sort of peacekeeping or military exercises overseas, the need for people to be in those bases diminishes as well. So that's where we are now. We're not really facing any huge military or naval threat. Maybe, you might argue that there's a small threat from China, but not really. In reality, we wouldn't see anything happening there. So, the need for these bases is diminishing. And the other thing about Darwin is that nearly 50% of the households are renters. This compared to, say, 30% around Australia generally, and a bit over 30% in our major capital cities. But in Darwin, nearly half of them are renters, and renters can move about. A lot of them are service people and others supporting the military bases, but it means that they can move a lot more easily and quickly than owner-occupiers can. And they do move, Moss, because 15% of the population move interstate each year. That is 15% in or out.
Number.
Oh, it is huge. Compared to 2 or 3% in other capital cities. So you've got this huge movement of people in what is really, and when you look at Darwin's population, it's it's the smallest capital city of all. It's smaller than Hobart, and that means that there's tremendous potential for volatility there. But there's something else, and that is that it's in the cyclone zone, and yet we haven't had a severe cyclone since Cyclone Tracy in 1975. That's 50 years without. There've been a few minor cyclone incidents, but nothing major. And now, of course, we've had this cyclone Fina, and this is at the date I recorded this, which is today. It was changed from being a tropical low into a Category 2 cyclone, and heading towards Darwin. Now this is done in November. They haven't had a cyclone approaching Darwin in November for over 30 years. So things are changing, and it could be climate change or whatever, but nevertheless, Darwin's at greater risk of getting hit by a cyclone than any other capital city in Australia. And this particular cyclone, at the time we recorded this, was heading towards Darwin. And so we hope that the damage was minimal. But the problem with cyclones is that they don't just cause structural damage, but they make properties unrentable. A lot of the tenants will just leave. They'll say, right, we're out of here. And we've seen the high rate of renters and interstate movements. So people just simply leave. And of course, you can't get any cash flow from rent. So either because the tenants have gone or because the house needs repair. So even if the cyclone only causes minimal damage, it can affect investors far more than other residents in the city. So, that's, to me, is a real red flag. There'll be more cyclones approaching Darwin over this cyclone season, and we hope that none of them, do hit Darwin, of course, but nevertheless, there is a strong potential for that to happen. And yes, Moss.
A lot of the times, people, especially like a lot of the activity that is happening in Darwin right now is investor-led or buyer's agent-led, right? They are there because they're chasing yields, trying to make it look like this is the, the next best thing, after white bread, right? But there's this, massive comparisons between Darwin and Perth and Darwin and Townsville. And they're like, oh, look at Perth. Perth used to do similar things in 2015 and it was a mining boom and it went down, it went up, and it continues to go up. And so I see a lot of buyers agents making that call and saying that, Perth is what Darwin is. Perth is what Darwin, or should I say Perth was what Darwin is today.
Yes.
And so, they are trying to justify, the growth that is coming through. What would you talk about that?
Well, it's just simply not true, because you can see the population growth rate of Darwin, the Northern Territory. It's very low. And so we haven't got that massive rise in population that we've had in Perth. Perth was coming off an oversupply of property that was caused when the mining boom ended in 2008-9. Everybody started building properties, and they had a massive oversupply, and that kept the prices down for around 10 years. There was no price growth at all until it became very affordable. But the difference between the two is that Perth is a huge city of over 2 million people. Darwin's got about 120,000 people. It's a much smaller market, and it's a very different type of market. Lots more renters, lots more people moving in and out.
I think one of the things that people don't realize is that when you talk about the population turnover that is happening in Darwin right now, majority of that is skilled labor. It's not unskilled labor. And so unskilled labor are people who are basically sitting there. It's the low socioeconomics of the world that still sticks around and stays in Darwin. And the city in itself has seen no serious amount of population growth over the last decade, right? It's almost like neutral or sometimes even negative population growth in some of those pockets as well. So fundamentally, it makes no sense, Darwin market to take off and kick off, knowing when the market around the corner or the mining around the corner is about to, tank, and China taking pressures away from the mining industries from, Australia in itself as well.
Definitely. And I think the other problem is there are too many speculative investors. They've been motivated by the low prices in Darwin. So, buyers agents recommending Darwin purely because of the high yields and low prices. And these two go hand in hand. The lower the median price, the higher the yield. So, once the prices start to go up a bit, those yields will fall away. But when you've got too many speculative investors buying for the wrong reasons, fear of missing out, you get what is called a property bubble. And that's what I'm concerned about, Darwin. I think when bubbles form, they burst very easily, and all it would take is a cyclone or reduction in a military presence up north. Any one of those things could cause that bubble to burst. And then when you've got all these people being investors, it means they can't get tenants, and so they decide to all sell at the same time. And we've seen that happen. I guess the thing is, how do you check whether or not it's likely to happen? Well, one early warning sign is to watch rental vacancies, because when you've got half the population renting, if you see rental vacancies start to rise, that's an early warning sign that it could be about to turn.
And there would be people who would make money, right? I call them opportunistic investors. They will make money. Will take an exit, and they do this. They move into the markets, make the money, get out. But majority of the mom and dad investors who've been bought into this dream of buy and hold it forever, I think those are the people who would suffer the most, because this is the market to basically sell and move as fast and as quick as possible, right? So
exactly, it's the people who have timed the market correctly and got in and bought at the beginning and get out before the bust. They will do very well, and we've seen that before with mining booms and the coal mining towns in Queensland, Moranbah and Blackwater and those sorts of places where the prices went up dramatically, and all the investors were competing with each other to buy. And I remember in Moranbah the price reached $1 million for a house, and the rent was over $1,000 a week, and the same up in Port Hedland in WA. So a lot of people made a lot of money, but the people who hung on for that little bit too long, when the market turned, realized they couldn't sell. And that's the problem you face, is because once the market starts to turn, no one wants to buy, everyone wants to sell, and the market could bust as a result.
Amazing.
So when we look at other areas around Australia, are there any other areas that present with these sorts of red flags? And the answer is not really. If you've got it doesn't matter if it's a large city or a smaller town, but if there's population growth and there's first-time buyers active in the market, we're going to see the first-time buyers, supporting the market all around Australia. but not so much in the Northern Territory, and certainly not in Darwin.
Yeah. And I think one of the key things to watch out for in 2026, because, ultimately what I always think is, it's the price point that dictates the opportunities as to where are you going to buy. As a, property investment advisor, when a person comes to me and says, Moss, I have an X budget, the budget dictates and decides as to, okay, where are we going to buy in Australia? Because that budget, every time the price changes, the opportunities change as well, right? One of the interesting things that I'm seeing right now, and this is predominantly in Melbourne right now, is that there is a lot less owner occupier activity that is turning up, but there is a lot of buyers agents activity and investor activity where people from Eastern Seaboard and Sydney, because Melbourne is still cheap, are buying quite a lot in Victoria. And Melbourne is an interesting one. There is a lot of first home buyers activity in the southeast of Melbourne, but when you talk about the west of Melbourne, where supply is quite significantly large, you see that real estate agents that I've been talking to, they constantly say that there's a lot of buyers agents who are buying investment properties because the rental yields are coming up, but there's not a lot of owner occupier activity. Do you think that there is any indications there that owner occupiers are not that active in Victoria and they're waiting for that rate cut to happen, or they're waiting for the market to basically switch?
I think they are waiting, and a lot of the activity is from investors. But I've also seen that where first-time buyers are buying property, because a lot of them, were obviously renters before, that they're actually creating more rental vacancies. So you can sort of see one working hand in hand with the other, and there are areas in Melbourne where the rental vacancy rates are starting to increase, and others where they're not. So it's very important, I think, in Melbourne to pick the right areas if you're an investor. Look to those markets where the rental demand is going to rise rather than fall. And when I say that, which areas do I mean? I'd say the inner western suburbs, the old inner western suburbs are far more stable than the outer suburban areas of Pakenham, Cranbourne, Melton, those sorts of markets, because that's where first-time buyers would be moving in. It'll be probably another year or so before they really start to become active. But it's a slow-moving market. It's speeding up, but it's still got a way to go.
Yeah. And if you have to call out on some of these major infrastructure hubs where you've seen major growth in Toowoomba and Ipswich and Townsville and Gladstone, all of these small, what I call it, is satellite cities, which are still super cities. One of the questions that the viewers and listeners always are asking is, there's been a massive growth that has already been through some of these pockets when you talk about Rockhampton or Yeppoon or Gladstone or Bundaberg. And then the market plateaued for a while, and then now you're seeing a second rise of the growth coming through, and people are a bit more skeptic about, hey, is it really happening? Is it not really happening? What is your comments on that?
What tends to happen in a lot of these areas where there were no price growth for in some cases up to 10 years, places like Gladstone, Rockhampton, Townsville, a long time with no price growth. And what that meant was that it became impossible for developers to build properties and sell them in competition with existing homes. So it's simply cheaper to buy an established property than to buy one that was off a brand new one. So it meant that developers just moved away from those areas, and the development in a lot of those areas, Mackay's a good example as well, just virtually stopped. Now you've got this strong price growth that's been going on for up to 2 years. And what that means is that suddenly it becomes possible for developers to start developing new houses once again. And we're getting close to that point. Now, once that happens, of course, the supply increases because developers move back into the market. And that means that the whole thing can slow down pretty quickly once that, supply is caught up to the demand. So I'd be, concerned about those cities that had a good run, and Mackay, Gladstone, Rockhampton, Townsville, all of those have had, quite substantial price growth. But what that means is it makes it more affordable for developers to move back in, and that'll slow everything down again.
I think in markets like these, the ripple effect is what basically takes over. So, you would have 10 different suburbs that have seen serious price growth, but you would have 2 or 3 pockets that haven't really seen growth and people don't really know about them, or, they've plays a blind eye towards, in those are the pockets that you need to really look for. In when you talk about Townsville or Gladstone or Mackay and all of these pockets. So it's not about a lot of investors. From my perspective, one of the biggest single mistake that a lot of investors think that they think that this is just one big market and they can buy anywhere there and it will just give them the growth, whereas picking that particular suburb and identifying the right pockets becomes very, very relevant and important as well.
Yeah, it does, and there's a lot of those cities too are very flood prone, so you can't just buy anywhere because you run the risk of the property going underwater when there's a tropical rain depression, and they do happen, and they're going to happen, which is what the Bureau of Meteorology is saying. Our climate we're becoming warmer and wetter, so these sorts of events are going to be more frequent. So yes, you need to watch very carefully where the property is located, not just from a growth perspective, but from a low risk perspective as well.
So if I close this off, what is the one biggest warning for Australian property investors this year that you're going to call out for people?
Well, to finish, I'd say watch for those rental vacancies, because if you've got more investors coming into the market and there's not enough rental demand, then the first thing that happens is the rental vacancies start rising. It's very easy to check. You just go into realestate.com.au and look up the number of rental vacancies in a suburb and track how that's moving. If you notice that there's a sudden dramatic increase in rental vacancies, that's the first sign that investors can't get tenants because they're advertising, and of course if they can't get tenants, they can't get any rental income, and then surely what happens after that is a lot of them will say, well, let's sell, let's get rid of this property, and of course then you've got the danger of the bust occurring.
100%.
So yeah, watch that. That one indicator is early warning sign, very accurate, very easy to do, and it'll save you a lot of heartache later on.
Spoken like a true veteran, spoken like a true mentor. John, where can people find you?
Well, they can go to my website, lindemanreports.com.au, and we offer a free consultancy. If you've got any questions, I've got a contact us form. You can fill that in, ask us anything. More than happy, as long as it's about the property market, of course, and more than happy to help. And in closing, Moss, I'd like to wish everyone every success in the new year. It's going to be a great year for property investors, but you need to be sure buying the right area and the right type of property. That's the key to it.
Thank you very much, John. And for viewers and listeners, if you want to reach out, you can always reach out to John through us as well. It's info@helpmebuy.com.au. As I said, a very happy new year, a very happy Christmas. And if you have any macro indicators that you think that we haven't covered, drop it into the comments below, talk to us, send us an email. Keep investing, keep smiling, stay safe, enjoy the Christmas season, enjoy the holidays. This is John and Moss checking out. We'll see you in the new year. Adios.